Now, I guess this move in the yield in the 10-year sort of brings back that 1999 hit by Brian McKnight. Back at 1, but this is, I guess, a little bit more. We're back at 0 on the 10-year yield.
Yeah, I think obviously this is the target for the BOJ, and that's important to remember. And it's also driven by global factors. Bonds generally are rallying. This is not specifically a Japanese story. Will the BOJ be concerned? I don't think they'll be concerned about the level. 0% is their exact level. Do they want negative yields? Not really. I think the more concerning for the BOJ is the flattening of the yield curve, and that will upset them. But the important thing for the BOJ is while they're not getting inflation yet, and inflation expectations remain very low, and it's unlikely they'll reach their target anytime soon, the Japanese economy is starting to pick up, and that's quite good given that they have a declining population. If they get growth of 1.5%, that might be okay this year. So I don't think the BOJ will be panicking about this.
Yeah, Mark, but of course, this is also sort of following what's happening in the global reflation story with that trade faltering. The U.S. 10-year yield right now gaining slightly, very, very slightly, but that, of course, after plunging to 2017 lows. I mean, it had to gain a little bit in this trading session. But if you take a look at the Bloomberg, you can also see that we are going to see some support at the 38, yeah, there you go, 38.2% retracement, and that would be of a sell-off from post-Brexit lows to its 2016 highs. But my question here would be, when will we see this gaining in Treasuries stop? I mean, what's going to be the factor that's going to factor into the yield direction from here?
I think a lot of people are kind of wondering when this clean out will happen. Obviously, one of the consensus trades at the start of this year was short treasuries, and we're seeing a big clean out of that position. I think at the moment this is a healthy correction. It's cleaning out some complacent positioning that was there. What we're doing is we're removing the Trump premium that was priced in. We're unlikely to get serious fiscal stimulus anytime soon from the US administration, unlikely to impact this year, which means we're removing some of that yield impact that was priced into the Treasury curve. However, the global economy is still picking up. The US economy is not running away, but it's doing okay, which means yields should be higher than they were 6 months ago. And that's what we're kind of seeing. So we're returning to kind of trend of where the level was going. Yields were climbing from July through up till November before the election. Then they jumped with the Trump premium. Now we're removing that Trump premium. At what level do US yields base out? Probably around here, but I don't think there's any major panic either way. Yields longer term will probably start rising again slowly, but not quickly. I don't think they're the big story here at the moment.
Yeah, absolutely. And I guess, this brings us all back to this, do we now just start to look at fundamentals? Because you talked about, has anything changed from, say, November, where yields are essentially at the moment? And the reason I bring that up is when you look at sterling, for example, there's still a massive amount of short positions out there. The move yesterday was about the short squeeze. Now, do we get a stronger sterling ahead, and is that going to be about further squeezing out of more shorts, or is there something fundamental that's actually changed with the currency?
That's a good question. I think we actually get a stronger sterling ahead that is related to a further squeezing out of the shorts. However, probably in the short term it's going to be a lot more difficult. We had such a large jump in sterling yesterday that I think the short-term volatility will be two-way, and it's very hard to call a direction. But overall, the next major move is more likely to be for further sterling appreciation. There is still this big overhang of speculative shorts out there. A lot of it was cleaned out yesterday, but there remains this short position, and yet the economic fundamentals have been improving for many months now. UK growth this year is expected at 1.7%. Only a year ago it was expected less than 0.7%. So that's a big improvement. We're seeing the current account balance improve. We're seeing the terms of trade improve. Overall, everything we're seeing about the UK economy in the last few months is a positive story. The election is just a trigger to notice this positive story. The next thing we need for sterling is to see the massive negative real yield start to narrow. And I think that's likely to happen in the months ahead, but short term it'll remain volatile and difficult.